So over the last 12 to 13 years, I've had some great success as a trader. I've flipped small money to big money. I've managed my own funds. I've also managed accounts for various companies through copiers or MAM accounts. And since 2021, I've also been helping others learn to trade. Now, I only have a small community of traders, and my students are highly successful. You can see here some of our results just this year with retail prop firms. Now, my students managed to secure these accounts using my really simple strategy. It's just supply and demand concepts, but there are a few key elements to the strategy that will help you apply it more effectively and become more profitable. So let's get into it. Now, one of the key elements with my edge is understanding what levels to trade. We have to understand basically that the market is doing one of two things. It's either in a trend, and this would be an uptrend, or it's ranging. And markets are either doing one or the other. So they're either trending up or down, or they're ranging. There's no in between there. Now, what you'll notice is that when a market is trending to the upside, we can join that trend much more successfully than we can counter it. Now, there is a way to counter it using my edge, but if this market is pushing up, for example, we would be looking at each swing point here or low for an area of demand. Demand we buy, supply we sell. And when the market is making these moves, we will not be looking ever to sell these levels. Not this one here, not this one here, because the market is in an uptrend. What do we expect in an uptrend? We expect it to take out the previous high. So not here. We're looking to join the trend when we can. Now you'll notice the one I've drawn here, it never pulled back far enough to give an entry on any of these. But this is just one time frame. So let's say this is the daily time frame. We make a push, we pull back, we make a push, we pull back, we make a push. There could be areas of demand here on a 4 hour. There could be an area of demand here on the 1 hour. All those areas could be relevant, and I'll show you that in a moment. But what you need to understand very, very basically is supply and demand. So if we're in an uptrend like we were just there, so this particular pattern where we're making a push, pulling back, push, pull back, say we pull back to this area here, and that is an area of demand, so an area that we would buy, and we expect a reaction, then it could look something like this. So we would be boxing off the body to the wick. And that's how that area could look just here on the chart. Doesn't matter what color this candle is, it could be red, it can be green, but all that's happened is we've had a drop, we've had a base, and we've had a rally. So there's been a move in, there's been indecision, accumulation of orders, and then a strong move away. Now the key is understanding the time frames, because what could happen, and I just mentioned it there, was we could have an area like this here on the 4 hour. But because we're in an uptrend, that looks appealing because the market is making a series of higher highs and higher lows, higher high, higher low. And remember, we're not going to sell this, we're not going to sell this. So how does the reverse look? Really, really simple. And I will show you guys some examples on the charts, of course. But as we're making a series of lower highs and lower lows, similar thing, we are not going to buy these areas. This one here, we're not going to buy that, but we are going to sell here. We are going to sell here, and we're going to look for any kind of areas of supply now, because we're selling in these parts of the charts as well. So for example, here, there could have been an area of supply. And how does that look? Well, that looks exactly as you see to the left, which is a rally, a base, so that's your base, and a drop. So rally, base, drop. Again, doesn't matter what color that candle is. It's a candle of indecision, accumulation of orders, and then a drop to the downside. So that's how it looks in simple terms. But how does it actually look on the charts? Well, let's take a look. Now, we've got Euro US dollar below, and I just picked out a time where we had a clear trend, because there are two different ways of obviously trading, or there are two types of markets we can trade. There are consolidations, ranges, or there are trends. So we're going to start with the trend because that's what we've just covered. Now this market made a low, made a pullback, and it made a lower high. Then it made a lower low, lower high, lower low, small lower high, lower low. Obviously inside this trend there is a 4 hour trend, there's a 1 hour, there's all different time frames, but this is the daily, and this is where we start. We always start on the daily time frame, and we're just simply looking for daily trend. Is it consolidating, or is it moving one way or the other? Well, this market is clearly moving down. So if we go back to that previous example where we drew the trend above and we marked off the supply and demand, we can look at all these areas here as areas of supply. So there's one there, there's one here. That was already done, this one here. But there was also one up here. There's loads of them, right? Because when we've created a push, we've had a pullback and we've created a new leg, pullback, new leg, pullback, new leg. And you can see even this one here, we rallied away, we dropped away, sorry, then we rallied back in and we triggered a potential sell. But we're trading those with the trend. So we have conviction in those levels because the market is moving to the downside and we want to sell it. There was even one of these here. So you can see that there's a small level just here, which was, again, another area of supply. So there's multiple areas of supply within this chart on the daily time frame. Now, I mentioned as well that you can also go down to the 4 hour. So when the market is moving in this downtrend, if we drop to the 4 hour time frame, because we've already got our bearish bias, we want to be selling that market ideally, what we can also start to do is look for 4 hour supply and demand. Well, I've just found one right there. So there is an area there clearly of supply. There's also probably a refined one here if we go down to the hourly, because on the 4 hour, there's just a bullish candle in, bearish candle out. If we go down to the 1 hour, you'll see that there is clearly an area of supply there. That's the exact one there. Now we can mark them off on the lower time frame, knowing that we have a bearish bias. And we're not looking as traders to take these positions back to the low. Although we think that this market is potentially going to take this low out, we're not speculating on long-term moves like that. As traders, all we want to see is a small bounce off the level. And how do you determine this? You determine this through your data. So this is where you start to collect data on levels. How many pips on average are we bouncing off of these zones? Are we with trend? Are we counter trend? Are we in a range? Euro, US dollar, what percentage of ATR are we moving here? This is 20% ATR, 16 pips. So I can measure whether this is doing on average 20% of ATR off the level. ATR is the average true range. I look at that over 14 days. So how much is this pair moving on average per day over the last 14 days? Is a 20% ATR stop a good position? Does it need to be 50? Does it need to be a fixed pip amount? 15 pips per trade, 25 per trade, whatever. You can see that if we used a 16 pip on that level, then it played out for massively positive risk reward. And again, that's where we look at our data. Did the level provide a 1 to 10, a 1 to 5, a 1 to 1? How many times are these levels providing 1 to 2, but we're taking 1 to 1? Therefore, we need to push our risk reward per trade. The data is the only thing that tells us this. And that's why my traders and my students have complete conviction in exactly what they need to do when we hit one of these zones. Because their data tells them exactly what they need to do, what the stop needs to be, what the take profit needs to be, based on their goal. I go into this in another video. If you look at whether your goal is prop firm evaluation passes and payouts, then you need to consider, I've got small drawdown limits on that account, so I need to try to get high consecutive wins. I don't want to hit long losing streaks. But if your goal is to manage money over 12 months and you just want to make the most amount you can, well, maybe it's more optimal to have some consecutive losses, but in the long run be hitting 1 to 3s or 1 to 2s, you know? So understanding your goal and your data and where it all fits in is really important. Now going back to the markets. So if we go on the daily time frame, we can also see that what happens in the market is, I always say the trend is your friend till it overextends. And that's why I have this 50 period moving average all the time on my charts. Because if the market starts to create distance between current price and the moving average, we can also take buy trades. And the buy trades we take are not based on these levels here. So we're not buying this area of demand, this area here, and this area here. We're looking left. All we're doing is we're scrolling to the left. We're looking at the previous trend. So we're looking at historical data. We're looking at where did the market previously create areas of demand. Now, if we extend this to the right, you guys will be able to see. So that would be that area there. We go left. Look how the market is reacting to those levels. And the market was creating large distance between the moving average and current price as overextended. There was a 4.3% difference between the current price and where the average price was over the last 50 days. So we know that the market was due a pullback, and that's how we capitalize on both sides of the market. We look at the fact that it is driving, making lower lows, but we're always looking left. So again, we could have been looking left through here. We could have been looking left through this area here. Remember, we don't need to see this market pull all the way back to the moving average. You can look on the daily at some of these levels. They will have played out for positive R, even though they look like the daily did nothing. If you drop down to the 1 hour, these levels play out more often than they don't. Over 75% of the time for sure. Now, if we look at where the market ended up here, for example, you can even see here, look, if we go down to this area, we start to refine what happened here on a lower time frame, we'll be able to see, so I'm going to go 4 hour, that there would have been a clear area of demand on the 4 hour here. So in fact, it's quite messy, but we would have to box off that whole zone. But we could see something like that. And again, the market has pushed into that area and driven to the upside. Now, how do we time our entries? Well, we time our entries through cross asset alignment. So I don't just blindly buy this. I'm looking at the whole market as one entity. Where do I think it's likely to stop? If you've got no understanding of cross asset alignment, download my free PDF under this video. It will show you exactly how I use it. But when the market hits these areas, then we time our entry using cross asset alignment. Now, although we have a bearish bias on this, because on the daily it's in a downtrend, you can see how we would capitalize on taking potential buys. What happens from here? So let's play this market out. So how do we determine when the market has changed trend? Well, what I like to do is I like to mark off the lowest low, and I always mark off where was that low created. So where was the previous high that created the low? It was here. The market then closed above it. So as we closed above, we could now consider this market forming some form of uptrend. And what's even happened here? We've pulled back into this really small area here of demand because we've now broken the highs. So we're in an uptrend and we've reacted. Again, there's a reaction there, and actually quite a substantial one. If you look at the overall move from the low to the high, we made an 87 pip move off of that level. This pair on average is moving about 50 pips a day. So that's a decent move over daily ATR off that level. What happens from there? We ended up having a gap down, but just no coincidence, we gap down into this area on a Friday close to Sunday open, gap down to this clear area of demand. Really simple again. What happens from here? Market starts to create a series of higher highs, higher lows. So we've pushed out of the zone, we can start marking off our levels again, and as we drive to the upside, then we get that big structural break. So we get that big push through this area here where we had all this resistance, and price is now in a very clear uptrend. What can we do for sales? We can look left. So we start looking left at the previous downtrend for areas of supply to sell, and we start utilizing areas of the current uptrend to buy. And we can do that on the 4 hour, we can do that on the daily, whatever it might be. Where did the first pullback come from? I mean, you're seeing it even here, like there's another one. We've just come back into that area of demand again. We've got this area of demand here, and the market then, again, that one's now played. These play out more often than they don't. You've got a reaction there, you've had a reaction here. This market's clearly in an uptrend. What do we expect? We expect it to take out this high. We're not going to hold it all the way to that high. There it goes. It's taken out the high. And again, we can still be dropping the time frames, looking for other areas of supply and demand on the lower time frames as well. Again, it's all about cross asset alignment. So if we see it, if we get that cross asset alignment for a confirmed entry, then we can easily take a trade. So we've got that 4 hour one there. This, again, I'm running this back test with no cross asset alignment. So you can see we've ended up accumulating a lot of orders at the earlier area here, which would have been a 1 hour area of demand. We've gone higher, and the market now has taken out the highs again, respecting this area of demand. The market's just doing this over and over. Looking for the sells, we're always looking left. Back to the daily, back to the previous trend. You can see that this area here was fully respected, just there. Because we're going counter trend on this one, we expect that to be taken out. We're not going to sell it again here, but we are going to sell when we tap in here. Really simple, guys. It's not that complicated. There's so many people that overcomplicate supply and demand. It's all about perspective, but it's equally all about using it at the right times. It's not just about blindly taking every supply and demand zone. It's about understanding what area of supply we're in, and it's all relative to the current market conditions. Is the market being driven by the stock market? Do we have cross asset alignment? Are we in an uptrend? Are we ranging? If you can answer all those questions, and you'll only do that through your data, then you have a really solid strategy that you can build on. Any strategy can work. Support or resistance, supply or demand, Fibonacci levels. It can all work. They work for different people in different ways, but it's all about context. It's all about how you apply them in the market. And the only way you get an understanding of how to apply them is by collecting data. Now, I had someone ask me recently, how do I find an edge in the markets? Well, I would start really, really basic. I would just start each day and determine whether you think the market is going up or down that day. I'd plot out some key levels, either support or resistance, supply and demand, maybe Fibonacci is fine, but I would use some simple key levels. The issue with Fibonacci is it can be a bit subjective about where you start it from. For example, if I had a Fibonacci from here, would I use it from there, or do I need to take it from the lows? It's quite subjective. Do you go from the impulse? Do you go from here? You know, it can be subjective. Levels can't really be subjective. If you have a set number of rules around a level and what determines a level, then it can't really be subjective. And that's what I have with my students. That's what I have in my strategy, in my trade plan. Now let's take a look at a ranging market and how this differs. So current market conditions on Euro US dollar, you can see that we are in more of a range, but we are in a short-term downtrend. So we're making a series of lower lows, lower highs, low, lower high. What do we anticipate next? Potentially lower low. Remember, it's all probability. Anything can happen. This thing can go back up to the highs. We are also in possibly a period of consolidation here. The weekly is going to look fairly sideways. You can see here, kind of not forming any direction on the weekly. But what do we do in these areas of consolidation? Well, this is where we can start looking at just the top and bottom of the range. So we can simply put an area of supply on the top of the range. We can put an area of demand on the bottom, and we can look to play those ranges. You can see here how the market came back in and tapped this area here. Eventually it broke, so there was profit out of that level. Remember, we don't need the whole move back to the low. Now we'd have a refined area up here, no doubt, on the 4 hour. Maybe even the 1 hour, because that's a huge news wick by the looks of it. That's a very big wick, so you're going to end up having to go very, very low time frame to find that area there. But if we look at the current market, we drop down, you can see that we've also got all these areas too on here. There will be a refined one somewhere there. There will be a refined one somewhere in here. So if I go down to 4 hour, I'll find those, and then equally refined one in here. There are all those areas as well that we could consider in this relatively sideways market. How do we time the entry? Cross asset alignment. Now let's take another look at a range. So this is a good example here on USD CHF. So yesterday we tapped into this area of supply. Previously we'd gone into this big area of demand. And you can see the market is in a range. There was also a level here at one point, but there was kind of a level there, so that had already been tested as one. There was also a level here. You can see that that level had also been tested here and worked. This is a ranging market, and in these ranging conditions we can just look at the tops and bottoms of the range for potential trades. So I would typically here be looking at when this market came down, it was in a downtrend, then it started to form a range. What happened was we respected that first area there of supply. Then we came down, we respected this area of demand here, see that? Then we made a low, so we made a new area of demand, making this one obsolete, and this one being the bottom of the range, and now this relevant one here being the top of the range. You can just see how we respected the top and the bottom of the range multiple times. So once you understand whether a market is trending or ranging, you can make a decision on how you want to trade it. Use supply and demand concepts. If you don't like that, use support and resistance, use Fibonacci, use fair value gaps, use whatever you want. If you want to use liquidity sweeps, but try to go with the direction of the daily market, so the daily trend. And if you're consolidating, try to trade the extremes of the range, so the very top, the very bottom, rather than trying to make a daily bias based on the previous day's candle. If you just take Euro US dollar for this week even, how do you even form a daily bias based on these candles here? This one completely indecisive, bigger wick than body, same with this one, same with this one, then we rallied. But prior to that, we'd had bearish price action. Now we've rallied today off of US dollar news. So there has been nothing for us to do today. We're simply looking at this market as a downtrend / consolidation. If we pull back into areas for sales, for supply, then we'll take them. Otherwise, we're not going to take the buys at this area. We're going to wait for the market to push lower and give us potential buys at maybe these kind of areas. It's all about context, guys. So hopefully that helps you with your trading.